Good afternoon, ladies and gentlemen. Please allow me to introduce myself. I'm Jay Hennick, the founder and chairman of the board of FirstService Corporation. I'll be acting as chair of this meeting, and before we begin the official part of the meeting, please allow me to introduce the people who are with me here today. Scott Patterson, the president and CEO and also a director of our company, Jeremy Rakusin, CFO, as well as Doug Cook, corporate secretary. Let me also introduce the other members of our board who are here with us today and ask each of them to stand when I call their name. Brendan Calder, Bernie Gert, and Michael Stein. Our out-of-town board members, Fred Reichheld and Aaron Wallace, unfortunately could not join us today, but we'd like to thank all of our directors for their services during the past year. In particular, I'd like to once again welcome Aaron, who recently joined our board. Erin brings a wealth of experience from her lengthy management tenure at Walt Disney Company, and we're delighted to have her as a valuable addition to our board. Before we begin with the formal part of the meeting, I'd like to take this opportunity to thank everyone for joining us today. As many of you know, this is the first meeting of the shareholders of FirstService as an independent public company following the spin-off transaction that was completed on June 1st last year. I'd like to welcome those listening through the internet, as this meeting is being webcast live through the FirstService website located at www.firstservice.com, where it will be archived and accessible for 1 year. And now it gives me great pleasure to call to the podium a person who I'm confident will prove to be the greatest CEO in the history of FirstService Corporation, Scott Patterson. Scott, I'm honored to pass the baton to you as the CEO. Congratulations.
Thank you for those words, Jay. And good afternoon, ladies and gentlemen. And let me welcome you again to our 2015 annual general meeting. As you heard from Jay, our very first as an independent public company. I'm going to kick things off and walk you through some of our operating highlights for 2015. Jeremy will then get up and review our financial performance, and then I'll wrap up the presentation with some thoughts on our strategy and our prospects for the future. Before I start, however, I want to take this opportunity to acknowledge Jay, our chairman, but also the founder of FirstService and the CEO for the last 23 years. Jay is in an unfamiliar seat up here after 23 years, but I want to assure you that he's still involved and close to our activities at FirstService. As you know, it's Jay's vision and tireless drive which has really charted our path to date, and all of us on the senior leadership team at FirstService consider it an honor to continue to build on the legacy. Personally, I want to thank him for the opportunity of partnering with him for the last 20 years. Today we have new titles and new roles, and I look forward to many more years of partnership because, Jay, we still have a great deal to accomplish. With that, let me now jump in and talk about some of our highlights for 2015, and I'll start with our very strong financial performance. We had a great year. Revenues were up 12%, EBITDA 37%, and earnings per share were up 43%. Very strong results, but candidly, these are results that we expected. Across the board, we hit the targets that we put in place at the beginning of the year. We expect this because we delivered it for 20 years. This is our revenue growth line for the last 20 years. 21 with 2015 added in. The graph represents the new FirstService divisions, FirstService Residential and FirstService Brands, and excludes Colliers and other businesses that were part of old FirstService over the years. The compound annual growth rate for the period is almost 20%. The remarkable consistency of this track record was somewhat hidden historically under old FirstService. And it's the increased awareness of this track record that we think is the principal driver behind another significant highlight in 2015, and that's the performance of our stock price, which is up a whopping 90%, while the NASDAQ's up 6%. Our shareholders, all of us, have done very well as a result of the spinoff last year, which allowed us to focus on FirstService Residential and FirstService brands and shine a light on our successful history, our proven business model, and the significant opportunities that we have in front of us. Operationally in 2015, both FirstService Residential and FirstService brands had very strong years. We accomplished a great deal in both divisions. Let me share with you some of our divisional highlights. At FirstService Residential, we had a milestone year with revenues hitting the $1 billion mark. As a reminder, we started this division in 1996 with the acquisition of a company in Boca Raton, Florida called Prime Management. This year, 2016, marks 20 years building this division. And today, we manage 7,500 communities comprising 1.6 million units. We employ 14,000 associates, and we oversee more than $7 billion in budget. And at $1 billion in revenue, we are the clear leader in North America, but our market share is still only in the 5% range. We have years and years of running room in front of us in this business. During 2015, we closed 7 tuck-under acquisitions within FirstService Residential, including 2 strategically important additions. Southwest Management Services, the property management leader in Austin, Texas, which is one of the fastest-growing metropolitan areas in the U.S., and American Leisure, the New York City-based leader in the management of luxury high-rise amenity facilities. This is a new, important ancillary capability for us in a critical market. The other 5 acquisitions were important in terms of enhancing our market share in existing markets. The second key highlight at FirstService Residential was a 36% improvement in our EBITDA margin as we start to see the efficiencies from our continuing investment in the operating platform. You've heard us talk about this over the last few years. We will see more improvement this year in 2016, and we expect to see more again in 2017 and 2018. Turning now to FirstService brands, revenue grew 16%, approaching $250 million. In general, we continue to benefit from the very strong home improvement market in the U.S., but at 16% growth, we are also very clearly taking market share. Today, FirstService brands consists of 8 distinctive, market-leading brands that together generate over $1.7 billion in system-wide sales through 1,900 franchised and company-owned operations. There are 2 key highlights I want to talk about today with respect to 2015, and they both relate to our company-owned strategy at FirstService brands. First, we launched our company-owned operations within Paul Davis Restoration with the acquisition of the Central Pennsylvania franchise. We partnered with Steve Rote, one of our most successful and tenured franchise owners, and Steve will continue to oversee our New Jersey, Pennsylvania region. Our goal with this strategy is to acquire 20 of our larger, more successful franchises over the next 5 years to create a national company-owned platform. This will better position us with our insurance company customers who are seeking a higher level of consistency that we will be able to provide. We love this strategy and believe we will be able to create a $200 million platform within Paul Davis Restoration. The second highlight relates to our company-owned strategy at California Closets. During 2015, we established our centralized production facility in Phoenix for our company-owned operations. We currently own 12 California Closet operations, and our goal is similar to Paul Davis, to get that to 20 over the next 5 years, reaching a revenue target of $150 million. Our plan is to drive all production through the centralized facilities, which will increase our margin in these operations by more than 30%. We currently have 6 of our 12 operations running through Phoenix, and we're starting to see the expected efficiencies. We see this initiative creating significant shareholder value for all of us over the next 5 years. Before I turn things over to Jeremy, I want to talk about a more recent, very exciting highlight within FirstService Brands, and that's the acquisition of Century Fire Protection that we announced last week. Century is a leader in fire protection and safety across 7 states in the U.S. Southeast with revenues of about $100 million. They install, repair, maintain, and inspect sprinkler, fire alarm, and safety systems. This is a new service capability for us and a very important strategic move. We've looked at the fire protection industry for years. It has many of the very same attractive characteristics as our other service lines. This is right in our wheelhouse. It's an essential outsourced property service. Clients don't do it themselves. The revenue is primarily contractual and recurring. The industry is very large and highly fragmented, with over 4,000 service providers in the U.S. And there is increasing regulation, which drives more compliance-related service work. Put simply, the industry fundamentals are very familiar to us. And if you consider that we manage over 7,500 communities, and each of these communities currently contracts with a fire protection company, the long-term cross-selling opportunity is crystal clear. But what really attracted us to Century was the prospect of partnering with Scott Tutterow and his team. Scott founded the business in 2000, and over the years he surrounded himself with a very strong team that share similar values and a similar culture to ours at FirstService. We see a tremendous long-term opportunity to grow Century organically and through tuck-under acquisition, very similar to the way we've grown our other businesses, the FirstService way. Now, let me pass the ball to Jeremy to go through our financial review.
Thank you, Scott, and good afternoon, everyone. 2015 not only marked a key milestone for FirstService in its evolution as a new public company, the year also proved to be one where, right out the gates, post-spinoff, we generated very consistent and strong financial performance. I'll take the next few minutes to focus on a financial review of our consolidated results last year, our capital allocation and balance sheet, and a look at the path forward. In 2015, I'm pleased to report we saw excellent operating performance and continued execution of our growth strategies in each of our business lines. This set us up for a year of robust growth across all financial metrics. As you can see on the slide, FirstService increased its consolidated revenues to $1.26 billion, up 12% versus 2014, while generating adjusted EBITDA of $103 million, up 37%, and adjusted earnings per share of $1.20, up 43% versus the prior year. And all this helped to drive very strong cash flow from operations of $87 million in 2015, a key indicator of the true earnings power and cash flow generation potential of our businesses. Turning to capital expenditures, we invested just under $20 million in 2015 in support of our continued future organic growth. This year, we expect CapEx investment to remain at similar modest levels of around $20 to $25 million, and our guideline over the next several years is for maintenance CapEx as a percentage of EBITDA to be in the range of 15 to 20%. In 2015, we also carefully deployed capital towards several acquisitions, investing $12 million during the year. As Scott mentioned, each of our tuck-under acquisitions were strategically significant in their own right. I should note that the level of our annual acquisition spend will fluctuate from year to year depending on market conditions as we maintain our valuation discipline and search for target acquisition opportunities with the right strategic fit. And our patience has clearly paid off in the early part of 2016, as our acquisition spending for this year will be significantly higher than in 2015. The Century Fire transaction announced last week stands out in terms of its relative size, revenues of around $100 million, and healthy profit margins in line with our other company-owned operations. Furthermore, the pace of our more typical tuck-under acquisitions has also picked up, as we have closed 5 of those year to date. We have seen the fruits of redoubling our efforts and expect to complete several additional highly accretive tuck-under deals within the foreseeable future. In addition to the capital reinvested towards growth of our businesses, our strong free cash flow generation also allowed us to reward our shareholders with an incremental cash return. This past February, in conjunction with the release of our year-end results, our board of directors approved a 10% increase to our quarterly common dividend, up to 44 cents US per share on an annual basis from the prior 40 cents US per share. I want to reiterate that as a growth-focused company, we will prioritize our capital toward expanding our businesses. But at the same time, our board and management, as significant insider equity owners alongside you as shareholders, know that capital allocation is important. And therefore, we will annually review our dividend policy, taking into account our financial and business performance and our outlook, all while maintaining significant flexibility in our capital structure. And on the subject of our capital structure, let me take a moment now to review our balance sheet with you. We exited 2015 with leverage at 1.5 times net debt to trailing 12 months EBITDA, with total liquidity from cash and our bank revolver availability of roughly $190 million. After accounting for the Century transaction and others completed thus far in 2016, our pro forma leverage comes in and around 2 times, a very healthy ratio and one well within the bounds of our target levels. and our financial capacity after these deals remains a sizable $110 million, keeping us in an extremely strong financial position to capitalize and pursue all of our strategic priorities. Maintaining a conservative balance sheet and our investment-grade credit rating has been and will continue to remain a key foundation of FirstService's discipline and growth strategy. It allows us to continue with our standard tuck-under acquisitions while also providing us with the flexibility to opportunistically capitalize on larger deals like Century Fire. Looking forward, we have previously outlined the roadmap for our 2016 forecast, so I won't revisit those parameters, except to say that we continue to feel confident about the momentum and the outlook around all of our operations and the financial targets that we have established for ourselves. Taking a longer-term view, let me conclude by laying out a few markers we aim to hit as part of our 5-year strategic plan. Applying the following 3 key driving assumptions: organic revenue growth in the mid to high single digits across all of our businesses, augmented by 5% acquisition growth at sub 5 times EBITDA valuation levels in line with our historical track record, and consolidated EBITDA margin expansion to 10%, we believe that by the end of 2020, we can achieve the following: a doubling of revenues, EBITDA increasing by approximately 2.5 times, and approaching a 3-fold increase in our earnings per share. There are no guarantees when projecting 5-year targets, but we are confident with the strategic direction of our businesses and the significant headroom for growth in their respective markets that underpin our projections. And if we are successful in achieving these metrics, we will undoubtedly build further upon the long-standing track record and legacy of value creation that FirstService has historically delivered to its shareholders. With that, I'll now turn things back over to Scott.
Thank you, Jeremy. As we reflect on 2015 and look toward the future, it's worthwhile reviewing the unique characteristics of our proven business model. Across our businesses, we enjoy leadership positions in very large, highly fragmented, essential property service markets. Yet our market share in each service line is very modest, generally low single digit. Let me show you. These are interesting metrics. In residential property management, as I mentioned earlier, we are the clear #1 player with approximately a 5% share in a very large market estimated at greater than $20 billion. CertaPro Painters, by far the largest painting company in North America, with a market share of less than 1% in a $40 billion market. Paul Davis, a top 3 player in full-service restoration, a $60 billion market, again, with a market share of less than 1%. California Closets, the largest home organization company in North America, with a market share of 6% in an $8 billion market. Floor Coverings International, Pillar to Post Home Inspection, and now Century Fire, very similar. Leadership positions in very large markets with a small market share. This dynamic across our service lines is conducive to consistent, long-term organic growth and significant acquisition opportunity. We've been following the same strategy at FirstService for over 20 years. My message to you is that we still have enormous opportunity to grow within our service lines. I want to emphasize FirstService is an organic growth story first. It always has been. It's been the key to our long-term consistency. 2/3 of our growth over the last 20 years is organic. We drive organic growth by leveraging our leadership positions to create value for our clients that simply cannot be replicated by our smaller, generally undercapitalized competitors. There are many examples of these differentiators. We've talked about them at this meeting in prior years. They include proprietary insurance and banking products, energy management, aggregated purchasing, robust call centers at all our businesses, some of them 24/7, so the phone is always answered by a human being, a big differentiator for us. And there are many others. Our greatest differentiator, however, is our people. We recognized many years ago that the key to consistent organic growth is the quality of our service, which is always dependent on the professionalism and engagement of our people. We invest far more than our competitors in recruiting and developing the very best talent in our markets. This translates into better service, a better customer experience, and as a result, we keep our clients longer and we consistently add new clients. Organic growth. As Jeremy pointed out, our long-term expectation is to grow organically by mid to high single digit, and then to take top-line growth to over 10% through tuck-under acquisition. We've achieved this for over 20 years, and we're confident that we will continue to achieve it. Creating value one step at a time. It's been our motto for many years. You've heard it from us before. The motto guides our daily decision-making and reflects our operating philosophy. It has also served our shareholders very well. A $100,000 investment in 1995 was worth about $4.5 million at the end of 2015. A 20% compound annual return over the period. We are extremely proud of this track record and determined to build on it for many, many years. That concludes our prepared comments. I want to thank you all for joining us, and we'd be very happy to answer any questions you have. If you do have questions, if you could please walk up to the mics that are in the aisles.
Way down here. I'm Paul Dernan from Burlington. You have a very small market share of the total in several of your markets. I wonder if consolidation and growth is not that easy because the competition are family businesses or very small ones that do this service. So it wouldn't be easy to add 20% with one transaction. So can you quantify how much of your competition are very small and family businesses?
Most of our competition are family-owned, very small businesses, mom and pop type businesses. We are an organic growth story first, Paul, so our focus is differentiating our sales, leveraging our scale, leveraging our capital, and investing in ways that those businesses cannot to keep our clients and consistently win new clients. And that's the 2/3 organic growth that you saw in that chart. That's our focus first. And then there are some of those businesses that have broken through and achieved a level that is $5, $10, $15 million in revenue, as opposed to $500,000 or $1 million. And we are able to tuck in those businesses and take our growth above 10%.
Okay, so there's only 1% of the competition that has 500 million in sales.
I said 500,000. Yeah,
500,000.
I would say most of our competitors are very small, but there are some that are suitable for us to acquire and tuck in.
Thank you.
Anybody else? Well, again, thank you for joining us. We will be available to answer any questions you might have at the back. Thank you.